welcome everyone to the second episode of season 2 of FINtastic Talks. It's great to have all of you, as I have been sharing that we have now crossed 1 million views or 10 lakh people who have watched these talks, and that's what keeps me going, keeps me motivated, and keeps me wanting to do it. And we are getting approximately between 10 to 20,000 live viewers for every talk. So thank you for keeping on recommending it and keeping on telling people about it. That's the only way we are getting so many people to join, and that's fantastic. And also, please know that we read all your comments and they come to us live as questions. So if you have any question in your mind, any thought, anything that is crossing your mind, anything you feel can add value to you, so please write in the comments, and we can see those comments and we will like to include that in the talk. Because today I also wanted to tell you that we have done a lot of work and introspection, that what are these talks about. So these talks are about helping you build a second income. And second income means that you are busy doing your own work. We want you to look at your portfolio as an investment, work with a wealth manager advisor like Bajaj Capital. And there has to be a little bit of marketing from my side for my company, otherwise they'll be very unhappy with me. And work with us and build a second income that helps you become prosperous, and one day contributes equal to your current income, and maybe other day becomes higher than the current income, so that you always have a backup and you're always rich and wealthy. The difference between rich is what is the money you have today. Wealthy is that what is the money you're going to have in the long run. So the answer is, if a person has 1 crore rupees today, he's rich. But if he's spending 10 lakh rupees a month, then in 10 months he's going to be broke. So he's not wealthy. So when your money can last your life is when you're truly wealthy. And our aim is to make you wealthy. And for those who are starting the journey or doing it for the first time, we at Bajaj Capital have also started FINtastic programs, which are available for kids, teens, women, even young generation. Please do that program. It's a small investment, but it teaches you basic of investment and wealth creation in a very fundamental and a proper professional manner. And that helps build the base. So nobody will be able to take you for a ride. Nobody will be able to give you wrong advice. And that's the key for creating wealth. So without further ado, I want to bring in a person who manages one of India's best funds called IDFC Mutual Fund. Their performance has been par excellence. And also a very unique proposition about Vishal is that he is one of the few CEOs of mutual fund industry who comes in from the advisory background. So he also understands very well how mutual funds need to be offered to the customer and what is their needs. So without further ado, let's bring Vishal to join us today.
So, hi Sanjiv, and thank you very much for having me and for the very generous introduction.
No, I always like your inputs, because I think you're the only one, if I'm not wrong, that who's actually been on the other side, and who's probably you're the one of the person who's understands the customer or the consumer or the investor behavior to the maximum possible extent in the mutual fund industry, and that's something we really appreciate about you. So just Vishal, we want to make these talks unique, and the way we do it is that we want to talk about you as a person also. So a lot of people will just talk about the mutual funds environment, what is happening in the economy. We want to understand Vishal as a person also. So why don't you tell us about your background, your childhood, what was it like, how did you end up reaching this position that you have reached?
Thanks, Sanjeev, and nothing extraordinary in all of that. So my childhood and my early years was in Calcutta. So as I call myself, I'm a Kapoor, therefore Punjabi by surname, but a Bong at heart, because I grew up in Calcutta, in a suburb of Calcutta actually, surrounded by engineers, because my dad used to work for an engineering automobile major, and therefore everyone I interacted with was an engineer. So was my family, my brother, my grandparents, my uncles, everyone was an engineer. So I think I was the odd man out in trying to pursue finance, which was in those days really looked down upon, as one can imagine, in like 25, 30 years back. You either had to be a doctor or an engineer to do well
ये
in
must be a बुरा must be a bad engineer. तो तभी इसको बेचारे को सेल्स की जॉब मिल गई है.
Yeah, so I think among my friend group, we sort of, this was the days of late 80s, early 90s. I don't know if anyone will recall, but this was the days of CCI and IPOs in stock markets, etc., which were very attractive. And one discovered that there is life beyond engineering, and this world of stock market was really fascinating. So I decided then that I'll be a bit of a breakout from my family pack and pursue finance. And one thing led to the other, and here I am.
So what? How did you get your first job? Like you finished your engineering. Did you do your masters and then you came into
No,
finance?
I
How did you break into the finance industry?
yeah. No, so I didn't do engineering. I'm saying that all my everyone in my family was an engineer. I was the odd man out, and I chose to pursue commerce and then an MBA. And then a campus job happened, as it happens from business school. So the campus job gets you into financial services. So the big bad world of Bombay and finance is what my first job was in. And in those days, this was mutual funds was a very new industry. This was, I'm talking about mid 90s. The private sector mutual fund had just about started, and I got the opportunity to work with some brilliant people and try and set up a brand new mutual fund. So I did that in those days with a group called ITC and Threadneedle, and we started a mutual fund then, which eventually got to taken over by Zurich and then by IDFC AMC. So that's a bit of history of.
ITC said needle. I remember that.
Yeah, that's right. Yeah, so.
So okay, and how did then the journey? How did it proceed after that?
Yeah, so I spent the first 5 years or so of my career basically in the mutual fund industry, and then around those times, a lot was happening in financial services. Then in the 90s was really after liberalization. There was almost an explosion in financial services across consumer banking and asset management and insurance and the works. So I decided to take a bit of a change in career and look at banking for some time. So I moved across to work with a retail bank which was getting set up. And then I worked with retail banking for many years, both on the advisory as well as the deposit side. And this was with Amex earlier, which was taken over by Stanchart. So I ended up with Stanchart within their wealth business, which is where, like you mentioned, I spent almost 20 years on the distribution or advisory part of the business, working with industry colleagues such as yourself and Bajaj Capital to look at issues that were common to all of us. Also, try and see what we can do to promote the industry overall and have more balanced growth. And then in 2016, I decided to come back. So it was a bit of a ghar wapsi into mutual funds when this opportunity came up, and I joined or rejoined the mutual fund industry in this role at IDFC.
Okay, that's superb. So, and we have done a lot of work on professionalizing this industry. And I remember at one time, a good advisor was once in a far and few. And today, I was discussing with someone today, you bad advisors are far and few. So there are a lot of people doing a lot of good job, and that's so nice and so heartening. And we are
Absolutely.
looking at, despite the crazy volatility, the people have stuck on, the mutual fund SIPs are still growing, and there's a lot of good domestic inflow that is happening. So, Vishal, coming to the topic today, what do you feel about the economy environment? People are there's some amazing statistics that have come out that all over the world there is a risk of recession, and India the risk of recession is zero. So that makes us feel superb. But overall, what do you feel is happening in the economy? What's the call of IDFC mutual fund, and how are you, uh, putting it into your investment strategy as a fund?
Right. Right. So, Sanjeev, we have to look at it at two different lens. One is, of course, as an asset manager across equity and fixed income, how do we position our portfolios for what's happening around? And there clearly, I guess, the risk of economic slowdown has been something we've talked about for quite some time now. Uh, and with the amount of liquidity that was flushed into the system by most central banks across the world, a lot more in developed markets than in emerging markets, especially in India. The risk of inflation, runaway inflation in that sense, was always there. I guess for the longest time, one felt that somehow one would not face the brunt of inflation the way we are seeing it right now. But I guess there's a combination of factors, the liquidity, of course, getting now aggravated because of supply constraints as well as a war, energy prices, etc. So all culminating in a level of inflation that the world has not seen, especially developed markets have not seen for a long time. Uh, so globally, I guess the challenges are very real and quite unprecedented. As in, this is a level of inflation the world has not seen for almost 30, 40 years. Uh, there is also, of course, the risk of slowdown because growth is collapsing, and with the interest rate hike that has been now put in place with successive interest rate increases, demand and consumption is also expected to actually taper off quite steeply. So that doesn't do a lot for growth. Now, having said that, I think it's important that while India is part of a global ecosystem and and developed markets are actually more heavily impacted in one sense, the Indian situation is not as dire. So, firstly, our inflation is nowhere close to what we've seen in the past. As in, all of us remember inflation being double digits for the longest period of time. So, 7-8% inflation is not something that we are so worried about. It's slightly higher than the RBI's tolerance band, so it's not completely a multiple over what the RBI was expecting. Two is that even after the the reduction in growth estimates, we are still talking about 7.5% growth at a nominal level, at a real level, which is not bad at all if you look at the overall scheme of things in the world. So if you're looking at global growth at about 2.5-3%, then India really stands out there at 7% plus expected growth rate going forward. Third is, I think, and again, that's where we come back to investing. As an investor, I guess that's where the opportunities lie, because as they say, be greedy when everyone else is very fearful. Now, I'm not saying that therefore there is an expected, and I have a crystal ball which expects a rebound tomorrow or anything like that. But the fact is that time after again, I think you've seen that when the bad news is all baked in and the world gets almost very very despondent about what is happening, that's when often in hindsight the opportunities for investing are probably the sharpest. And which is where, if you're looking at equity investing, which a lot of people should, you have to look at the next wave of growth, not just look at timing the market and look at the next 3 months or 6 months or maybe even a year. And that's where I think, if you look at, let's say, a couple of factors. Firstly, valuations are a lot more modest now because markets have corrected, especially in the last quarter. Second, with 7% odd GDP growth, nominal growth of PAT by most companies, the market expectation is still in the mid-teens. So yes, of course, we'll see how that plays out, whether it's a positive surprise or a negative drag. But a mid-teen PAT growth cannot be shirked away. This was not the case 4-5 years back. We were struggling to get to double-digit growth. But after 2 years of fantastic growth, you're still looking at a couple of years of reasonable growth. And therefore, I would say that let's be cautious about getting too despondent in this market. Let's look for the opportunities. And clearly, there are a lot of bottom-up opportunities in sunrise sectors, in companies which are putting fresh capacity, companies that are going to benefit from inflation in some sense. Keep in mind, inflation is not necessarily such a bad thing for companies, especially if you can pass down the price. So we would be overall cautious, but I would still be quite optimistic.
Okay, that's superb. That's very, you know, heartening to know that still, we are lucky to be in an environment where there is a, lot of bullishness, and also that we have seen that the regulators have been quite proactive So, Vishal, I know this is a slightly off question, and I don't know whether you'll be comfortable answering it or not. The RBI has taken this effect of asking all the banks to offer exceptional rates on NRE deposits and not include them as a part of the SLR. And you having a banking background, that's why I'm asking you this question: that what's the purpose of that? And would how would banks justify these high interest rates they're paying on these NRE deposits?
So I think the as the if you remember in 2013, the RBI had rolled out a special FCNR window at a time when you really needed as a country to shore up foreign currency. This was a time when there were, I think, the eurozone crisis and a lot of volatility in the market, and that additional inflow of NRI money through FCNR deposits really did do a lot to sort of stabilize the rupee and have the sort of war chest that the RBI needed to provide reasonable stability in the currency markets. So I guess the attempt seems to be similar, which is to while I guess it is widely known or at least anticipated that the RBI has been trying to keep the rupee relatively smooth, and has also expressed views about what's the tolerance band in a sense that they will accept. Otherwise, they will come in and intervene in the market. I guess the attempt is here to sort of shore up the defenses to the extent possible. I'm not fully aware of the transfer price mechanism between the bank and RBI, but typically, there has to be something left in it for the banks to be able to offer or offset the additional cost that one bears in helping out and collecting these deposits. So I think the overall effort seems to be to sort of shore up the defenses should there be need for more support. Having said that, I guess economic growth and relative inflation does have a straight play into how currencies behave. And I think there's also a strong argument that the rupee was overvalued for a long period of time, so a little bit of slide may not necessarily hurt. Of course, in the near term, it hurts with a higher import bill, especially when oil is so expensive. But think exports as well, and it does actually benefit on the other side. So on the whole, not as negative a picture in a sense.
Yeah, but India is not truly a very strong export economy at the moment, and a lot of economists are talking about that it's time to have a stronger rupee. And because we are truly dependent on imports, and even at the cost of even exports going down a little bit, but if the rupee becomes stronger and the rupee cost, so the cost benefit analysis is going to be better in terms of rupee becoming stronger. uh, what are your thoughts on that? Again, I know we are off topic, but
Yeah. So again, we really don't take, being a domestic fund house, we really don't take an active view on the rupee, because our investors invest in rupees and we invest in turn in domestic assets. And I think we've heard both arguments to that extent. So if you talk to the exporter, of course, they're very happy. For the longest time, they've made the argument that why are we trying to keep the rupee so strong? How does it help? And it actually does blunt your export competitiveness. The argument on imports is also there. There's also the argument that if you import relatively cheaper, then the value add and the ability to transmit better value through export is also that much higher. The immediate import bill on oil or energy is the concern. So I guess clearly there is a case for relatively strong rupee in the near term benefiting. But I guess currency finds its own level over time. So as long as it's not hugely speculative, I think let it be where the market feels it is the right level.
yeah, I thought let's just cover it a little bit because this is the topic of the hour. Also, let me ask you, Vishal, you have got a very, very solid and a very strong fan base as a mutual fund, because there are some people who just swear by IDFC mutual fund and no, we this is the fund we want, and especially some of your schemes are very popular. And at the moment, your NFO for the mid cap fund has opened, and it's At least we have seen there is a very strong demand for it. So why don't you tell us a little bit about that? Why a mid cap fund at this moment? Do you think there is a specific opportunity, or this was something that you feel there is, this is a long term play?
Right. No, thanks, Sanjeev. Firstly, thanks for the compliments on the fund house and our, our loyal investors who have, made sure we try and do our best every day. On the mid cap fund, I think a couple of things that I want to highlight, and some of this may be well understood, well known, but it's just useful to sometimes step back and see it once all over again, right? So, firstly, I think we all understand that mid cap, by definition, carries a bit more risk than large caps, and therefore should expectedly give you more returns than large cap, right? So that's, I think, by and large expected. When you look at the data of how much extra returns over large cap have mid caps been able to generate, I think that's where the story becomes very interesting, right? So, if I were to do a poll and ask our viewers or ask people around that, by what percentage points do you think mid caps have outperformed large caps? I don't know if people want to, write their responses on the chat box.
But
But
on what type of timeline are we
time
talking?
frame, let's take 3, 5, 10, whatever you like, because the numbers are pretty consistent. But let's take 5 as an example, right?
Let's take 5 years, guys. Please put in the chat and the comments that what do you think is the average 5-year returns, or let's give a do you have the average 5-year returns of the large cap funds, Vishal?
Large cap versus mid cap, what's the difference? It's a simple one that way, right?
Okay.
As in, what's the difference
What is
between
the
mid cap and
percentage
large cap?
difference? So
Yeah.
do you
So if,
feel
let's say, as an example,
2%, 5%?
yeah, that's right. Because if you think that large caps, let's say, return 6%, then it was mid cap 7%, which is 1% plus, or 5%, which is 1% minus, or whatever the range is in a sense, right?
Yeah, so let's gamify it. If anybody answers the question exactly right, then they get some Amazon vouchers from Bajaj Capital team. So there's a Sandeep Kandhari who said 12 to 15%. Guys, come on, we have 11,000 people watching this chat. So, I think we should have many more answers.
So just to be clear, we're looking for the difference between mid cap and large cap compounded returns over 5-year period. Okay, 15%, 10%. Okay, 10% difference. That's interesting. Or 15% difference is interesting. 15% cumulative. Okay. Okay. Let's. I think in the interest of time, Sanjeev, if I may move on. So what we found is that even for 3, 5, as well as 10-year periods, right, where large caps average about 11% or so, plus minus 0.5%, mid caps average between 16.5 to 17%. So think about the difference between mid and small and large caps over compounded periods, not just 3 and 5, but over 10 years as well. And that to us is a very, very lucrative amount of alpha or outperformance versus large cap that one has to look at very seriously, right? Now, the other point I mentioned was that, of course, if large caps are relatively stable and steady, mid caps are more risky. Therefore, we said let's look at risk-adjusted returns, which is simply put, return divided by standard deviation or any other similar measure of risk that you want to take. There again, between large caps, mid caps, and small caps, which is the other category which is very popular, we like it as well. Mid caps really stand out. So on a risk-adjusted basis, again, it is the sweet spot. That's why in our campaign we are calling it the sweet spot between stability and return, because it has some characteristics of established companies. These are not nascent companies, nascent industries. These are companies which are well established, have a good track record, are in industries which are doing well, but yet still have the growth potential that you want out of Indian equity investing, right? The third characteristic, I think, which is very important to look at is that while large caps, the top 100 companies by market cap is the way we define large caps in India now, the number of industries that become available for mid caps has actually expanded quite a bit. So when you look at investing in mid caps, you actually do get access to a lot more width of industries and sectors than you do for large caps. So that's another very strong reason to look at large caps very seriously. What it also allows you to do is, as a stock picker or as a fund manager, hopefully the potential for alpha increases. And let me just share a quick number with you. So if I look at, let's say, 3-year compounded returns for individual stocks and look at some of the companies which basically because of being very, very strong in their performance, let's count the number of companies which have delivered, let's say, more than 40% performance over 3 years, 40% compounded returns over 3 years, which is really an outlier and therefore a fantastic stock in everyone's books, I would guess. The count of such companies which delivered more than 40% return compounded 3 years in a large cap was just 5. And for a mid cap, it was as high as 23. So, the point is that the number of companies that can really give you outsized performance, as in this example, 40%, was a lot more in the mid cap territory, which allows the fund manager to actually have a lot more, selection, and therefore the potential for alpha. Now, the common question that keeps getting asked is that, yeah, all that is great, returns are great, etc. But what about entry point? Isn't the valuation too expensive? Which I think most fund managers have warned again and again over the last many quarters that, look, everything is good, but valuations are expensive. Earnings are good and everything is great, but valuations are expensive. But what you also notice is that at the end of the last quarter, when you had a fairly sharp correction in mid and small caps, when you look at the current trailing P of mid caps, it's actually lower than its historic mean. So the entry point also becomes not in expensive territory. It's at least lower than the mean. So you can't say that you're entering at a time when it is overpriced, at least, right? Of course, we all want to invest for the long term, but and we've also got a lot of studies which say really the entry time doesn't matter. But the fact is, if you're worried that, look, am I getting in when the markets are too high and the price and the P is too rich? The fact is, no. Historically, actually, you're getting in at a time when the current P is actually lower than the average P over the last several years. So entry point is also not that bad. And again, I think the other thing we look at is that the common mistake I guess all of us make is that we look at past performance and past returns and we bet our money on the funds or the sectors which have produced the best past performance. That's just very natural for us. When I think study after study will tell you that actually it's the converse that should be happening. It's very likely that something that has not performed in the past will get it right, provided it's good quality, of course, in the next wave or the next cycle, right? So when you look at mid cap and you look at past 1 year returns, that is actually in the almost the negative territory. And within that territory, studies show that the next 5-year returns, when you start at a negative territory over the past, the next 5-year returns can be very, very attractive. Historically, that can be as high as 22% is what past studies have shown. Now, we're not promising that, we're not saying that that's what you should come expecting, but the fact is, at least probability of getting it right over the next 5 years seems to be in your favor, just looking at past data. So these are just some of the reasons, Sanjiv, that we thought that while it is a well understood category, some of these data points we may miss out on. We don't realize it as much. And, it's a good time, therefore, to look at this category once again.
Yeah. So, guys, for me to summarize for the viewers is that okay, look, mid cap is been an area which has not performed that well, but it offers a great opportunity because in the long run, in the last 5 years, it's outperformed the large caps by about 4%. So if you're looking at creating exceptional returns and by taking extra risk, then this can be a good area for you to look at. And given the fact that these mid caps and have been underperforming, and they are not as high risk as a small cap. So if you are willing to take higher risk than a large cap, then you can look at having mid caps in your portfolio. Vishal, I'll just add one question here: that what should be the ideal time period for people to add the mid cap fund? Maybe would you say is it 3 years, 5 years, or even longer? So if I'm entering and I'm making mid cap as a part of my portfolio, what is the period I should look at?
So, and I know, Sanjeev, you know this much better than I do. I would say the ideal period is forever till the time you need the money. So, unless you need the money, why do you want to withdraw? And then give it as much time as possible, as much as possible, right? That's the best way for you to make sure that you get the full benefit of some of these investments. Having said that, if you do have a goal in mind, I would say that the sweet spot should definitely be 5 years plus. Uh, you know, 3 might be stretching it, as in you could get the cycle right. But keep in mind, like I just mentioned, there are a reasonable amount of headwinds in the macro environment. These are the headwinds that actually do provide the opportunity. But will you actually be able to encash all those opportunities over 3 years? Anyone's guess. I would say it will be better or safer if you think about a 5 year period to look at mid cap opportunities. But ideally, hold it as long as possible till your objective is met.
Yeah, yeah, I think you've said it amazingly well. Look, guys, don't take your money out till you don't have the need. But yes, you also have to be careful about your portfolio, that you have done the right selection, right manager. So that's what you should be discussing with your wealth manager. That have I got my managers right? Have I got my allocation right? And I am, and I think Vishal is bang on. I would have said minimum you should look at 3 years, but 5 years plus is the ideal. So, guys, if you have any money that you're happy allocating to 5 years plus, and if it's 10 years, amazing. Then I'll say that definitely if you can put aside that money for 10 years more, or 5 years plus, then definitely look at an IDFC mid cap. It can give you a decent amount of alpha, and we know the power of compounding. I always share the formula. It's 72 divided by the interest rate is how quickly your money will multiply. So example, you person gets a 36% return, then the money will multiply every 2 years. So after 2 years it will become 2, then 4, then 8, then 16, then 32. So the power of compounding is the magic. It's the eighth wonder of the world. And there, by taking that extra return for getting, even if you are getting able to get 4% extra over 15, 20 years, is going to make a huge difference to your corpus. So it is worth taking that risk. Yeah, last talk Vishal, reason is because we had covered large cap in the last talk. So, and there we were discussing that, I personally have a lot of my portfolio in large cap at the moment, because I truly believe that for the next 1.5 years, with the volatility, the money that you is not a very long term money, but I think decent part of your portfolio should be in large caps. So that's my personal view. And so we were discussing large caps and how actively managed large caps may be able to do well. Otherwise, what we have seen overall, the markets have gone up or gone down. So also this is a question we ask all the CEOs who join us on this program. Vishal, you have 1 crore rupees today. And you have to invest them into equity funds alone. So you don't have to get into risk planning and this thing. How would you allocate your portfolio today? How much of this would go to large cap, mid cap, small cap, and how much of you would go to this thing? I know as a CEO, you'll say one crore into mid cap, but but what would be the ideal investment on today's scenario for you?
No, so Sanjeev, I am a big believer in diversification, and and therefore I will not say that put everything into one category alone for sure. Uh, I am also a believer in a sense of in a sense less active investing, which is I don't think I can get the sort of calls right and keep moving things around a lot. So my ability to sort of pick and choose and say, okay, now the next wave, large will do better, or mid will do better, or small will do better, etc., I feel is limited. Therefore, to be able to manage risk at an aggregate portfolio level, I think you've got to have a reasonable exposure to all three. When I'm saying all three, I'm just simply dividing up into large, mid, and small, right? Large provides you with the stability. So suppose risk increases in the economic system, then that is the portion that will allow you to have a lot more stability in your portfolio. So therefore, you must have some amount of money there. Mid is where, like I mentioned, is the sweet spot. It's a good combination between growth and stability. And small is where you're taking real risk, because these are unknown, relatively unknown company. The chance of failure is relatively high in some of these picks, etc. But these are also the multi-baggers of the future, right? Now, based on your risk appetite, I will say you will have to do the maths. If I am a bit more of a risk taker, I will probably do a third each today, because 67% for me in mid and small is absolutely fine, given the way I see India's growth really shaping up over the next decade. We have to, like I mentioned, we have to look beyond the immediate slowdown that the global economic system is seeing. We have to look at the amount of not just service but manufacturing activity, the innovation, and a lot of the infrastructure spend that has happened in the economy over the last couple of years, and what that actually portends for corporate earnings for the future. We now have a very relatively deleveraged balance sheet across both companies as well as banks. So if you were to look at it, the dry power, both in terms of ability to finance as well as the potential for growth, capacity has been, as we know, capacity has been a constraint in the past. That has all been exhausted now. So the next wave is what you're playing for, and I think large, mid, and small, all three will have to be in your portfolio.
Okay. So you're virtually creating a flexi cap for us.
Closer to a multi, actually, because a multi, keep in mind, has to have 25, 25, 25,
Yeah.
and the balance 25 is actually more discretionary. Flexis often tend to be a lot more large cap dominant. Not in our case, we've been a lot more disciplined in that sense, but across the industry, the average large cap exposure in flexi tends to be quite high.
Okay. So Vishal, you guys have always been known for being very good stock pickers, especially in the mid caps category. Why is that? What makes you mid cap specialists? Why is that happening?
I think, to be honest, Sanjeev, it's I guess the team's ability and rigor in both analysis of understanding of the sector as well as the experience that collectively all our managers bring in is probably what I can sort of relate to. There is a process that we follow which makes sure that the core boxes are ticked very well, and then within each fund we define the amount of risk or the style with which the fund will be managed very very definitively, or a lot more sharply, I would think, than just leaving it open and saying do your own thing. uh, so I think stock picking goes back to just having good analysts and having a deep understanding of various industry sectors, and having a good amount of network in the market, and then having the right experience within the team. Clearly, if you look at some of our senior managers, Anup, Sachin, Dylan, Sumit, all of them have done very well uh, in their past with stock picks. And I think the combined management, I guess, experience as well as the analyst pick allows us to hopefully, continue with that momentum of being good stock pickers.
That's excellent. So also, let me. There's one of our regular viewers, Mr. Sandeep Kandhari. He's asking a question: how would you rate the market in the present time? Have the FIIs started investing again into India? And also, that what is markets are improving every day. What's your outlook? Is this improvement going to continue, or it's just something coming in for some time?
Yeah, I wish I knew, Sandeep, and the honest
None
answer.
of us knew, but no, none of us know. It's just a perception. And guys, let me put a disclaimer. If anybody in this world tells you he can predict the market, it's absolute BS. So please don't believe in it. There is no fortune teller that if that person doesn't need to do anything, he just simply needs to buy stocks. He will not be available to you. So nobody can predict it. And but what is your perception? But a question like, have FIs started investing in India again? What are the metrics telling?
So, so have FIs started investing in India again? I can't say that that trend is reversed definitively as yet. I guess if we step back a bit, right? So there was a time when the world was flush with liquidity, and with liquidity being so freely available, typically assets, get chased after, and that leads to prices going up, which is what we saw post COVID. So a lot of liquidity flushed into the system, and in 2021, you had a very strong market, pretty much every asset going up. Right? Then you have a moment of in a sense the dawning of reality, a moment of shock, whichever way you want to look at it, and you realize, oh my god, this all this liquidity is not free. This is a drug that has to be withdrawn from the system. And then there's a bit of a shock. Now, does that shock lead to a complete risk aversion? And maybe the first round will be something like that, which is you pull out of assets and go back to the safety of bonds. And especially if interest rates are going up, you have that benefit of having at least better yield on your money, right? So we've seen that wave as well. Clearly, India was a relative outperformer, actually by a mile, relative to other emerging markets. So FIs pulled out from most emerging markets. India did not see as much of the pain as maybe many other markets saw, potentially also because domestic flows in India were very strong. So pretty much as much money was withdrawn by FIIs, the similar amount of money was continued to be invested by domestic investors, and therefore we did not see as sharp a drop. Relative, therefore, valuation in India continues to be very healthy. We didn't see, that sort of pain that emerging markets saw. Now, if you're looking at the next phase, I guess the first question is, at what stage do investors, FIIs, now get past the risk aversion phase? Are they ready right now? Are they going to wait a bit longer? That's the first question I would ask. If we believe that they're not as yet ready, because inflation is still not firmly under control, while the Fed has been quite categoric about what the target rates are. There's a market out there which may have a different view. Maybe there are trading strategies there that allows them to make more money. But eventually, in most such cases, the question will become, where is the growth? And clearly, the growth is not going to be as strong in developed world. And that's the phase that I think I would be quite excited about, because that's the phase when emerging markets again become favored, because that's where the growth is. We just talked about the fact that even while India's GDP forecast has been reduced from 9 to 8.2 to now 7.4%, it's still 7% plus. How many economies are giving you that level of growth? The rupee is been knocked down, and therefore entry point from coming back for FPI, you're getting it cheaper than where you exited. So that's another plus for them. That's a move I think you should not lose out on. When will that start? Of course, one won't get a lot of warning signs on that, and therefore staying out of the market, that's the risk you run. Because if that trend reverses, keep in mind, that's a risk you run, where the markets just move up too quickly, and that move was lost.
Yeah, so guys, we are also getting team. This is a message to the Bajaj Capital team. A lot of people have interest in the mid cap fund. They want to know more, or they want to know invest. So if you can put up a QR code or a link for people who are interested in that, so that answers that question. Now coming back to our talk, Madhu, there's a Madhusudan who's a very regular investor, and he's been regular viewer of this talk, and he's been regularly asking the same question, that Indian markets are different when rest of the globe is looking under recession. Why is there a super duper belief and euphoria behind India? I know we have already answered this question a couple of times today in the talk, but I will put my 1 minute sentence. Because India's domestic consumption is very strong. India's population dynamics is very right. India is an economy which is where some right investments are being made, and I personally feel that the manufacturing sector can come up, and so India is going to have an amazing future in the future. And there is a problem happening in Taiwan, China. So manufacturing can move to India if India does the right things. So that opportunity is there. Vishal, would you like to add on to this?
I think it's very well captured, Sanjeev. I think you hit all the right spots. Which is, yes, one has to be cautious, because India can't be a complete outlier from the pack. But the fact is that domestic factors are much stronger. And like Sanjeev mentioned, there are so many positives that one has to also think about. Uh, Again, like I said earlier, we want to be cautious, but let's not get so despondent or so pessimistic that we, let go of the longer term opportunity that this economy will present.
Yeah, and also understand, like, when the times are good, everybody is a hero, and you cannot spot that hero because everybody is doing well. But what happens, especially in the global economy, also when the times are not good, and there are some people who are doing better than the others, then they get easily spotted. So if India can get spotted as the hero, then the money will start flowing back into the India. See, right now, what is happening, a lot of the trading, international investing is happening on a passive mode, where money is getting allocated, and if the markets are dropping or the interest rates are going, the algo is pulling the money out. But these algos are changed over a period of time depending on the strength of the economy. So if India is able to get a better allocation, then the money will start flowing into India at a much better pace, which will help prop up the market. So that's one of the opportunities. It may play out, it may not play out. But guys, this is the time to be invested in the market. That's my simple thing. Also, Vishal, let me ask you a question. The people are very confused about debt funds, and that, do debt funds actually have a place other than the corporates? We are not talking about corporates or other people who have to keep money in debt funds. But for an investor, does he actually look at a debt fund, or balance advantage have become the new debt funds of today? Where earlier, like, people used to have a typical debt fund, today everybody is looking at a balance advantage fund as the alternative to debt. And I meet so many investors who tell me, like, my debt portfolio is finished and it's all in balance advantage. What do you feel about that?
So I would say that what's important is what is your allocation, what's your target allocation, and if, let's say, as an example, your target allocation is, I'm just taking a number, 70% equity, 30% debt, and an aggressive hybrid fund or the old balance fund meets that need for you, then so be it in one way, right? If a balance advantage fund meets that need for you, then so be it. Nothing wrong with that. Of course, it becomes more tax efficient, as you understand. But there are specific advantages of debt fund, especially when you have to liquidate part of your portfolio for a specific need. Keep in mind that when times are good, one can get a bit carried away and not worry about as much the need for nest egg or safety. And debt is that safe component that is very important. Uh, so therefore, theoretically, while a 70-30 allocation can be met by a aggressive hybrid fund or a balance advantage fund, practically, when you need that cash and let's say markets are down, will you feel okay about liquidating that balance advantage fund at what you think is a loss to get that cash is the question, right? And at that point in time, you may tell yourself that had I kept it separate and kept 70% pure equity funds across some mix and 30% debt funds across some mix, emotionally, it's just much easier to be able to liquidate that debt at that point in time at a profit. So while again, I think we all understand that while there is the maths and the logic of it, end of the day we are all emotional human beings, and it's easier said than done, right? So it's not that easy to be able to sell things at a loss, while technically it comes to the same thing, and
So
that's where I think the theory of debt is useful.
where would you keep your money today? You would keep it in a debt fund, you'll keep it in a balance advantage, or would you keep it in a target maturity fund? Why don't you tell? And does IDFC do target maturity funds?
Oh, absolutely. We were, in fact, among the first to offer this. I think we've got a long list of innovations in our products, and I think this is one of them. What we offer are two pure gilt target maturity funds. We have liked the 4 to 6 year band of maturity. The reason for that is that the yield curve is very steep up to the 5 6 year period, and after that it flattens out. So, in our view, the 4 to 6 year period is actually the sweet spot for investing in debt today, provided you can hold to maturity or you have a reasonably long time period for your investment. And the yields available today are actually very mouth-watering. You know, these products, on a YTM basis are currently, because it's an index-based product, there is an index YTM, and that is still in the 7 quarter odd region. A few months back, if someone offered 7% return, that was absolutely mouth-watering. Today, you're getting that on a gilt fund, and which is very tax advantageous, very low cost, etc. So I would say that if you want safety of capital and 7% nominal return, six something post tax post expense return is acceptable to you, why not? It's a very healthy rate of return in current market conditions.
So that's very interesting. So, guys, just to explain what target maturity funds are, this is one of the ways. Like when mutual fund is in a debt fund is buying long term debt, then there is a mark to market problem. Like the interest rates are going up, so the debt fund will end up giving a negative return, and people, despite debt being very secure, end up getting a negative return because market interest rates have gone up. And this reverses when the market interest rates are going down. The return may be 7-8%, people may be taking out 13% in a year. So in order to, but there are people who want security or stability. So target maturity funds work in a manner that, look, if you can put your money for 4 years or 5 years or even 1 year, so there are different target maturity funds. So depending on your horizon of your money, you put your money in a target maturity fund. Maybe suppose you can put your money for a 4 year fund like Vishal is talking about. Then the securities you have bought are going to mature in 4 years. And if you can see an indicative return of 7%, then you're almost 99% sure you'll get that 7% return, despite the mark to market happening of the returns going up or going down. You don't need to bother with that. So, Vishal, I know I'm a novice on that, but have I been able to answer it properly?
No, no, absolutely, Sanjeev. You've done a fabulous job. I think the trick always is in debt fund that we get compared to fixed deposits, and I keep reminding everyone that fixed deposits you don't see the mark to market because there is none. And if there is some way that you could invest in debt funds and not look at NAV till the time you really have to withdraw your money, you would be much happier. Take it from me. So it's the daily NAV and the volatility that really I think causes a lot of anxiety. But think about it like a fixed deposit in the sense that, look, I put in certain money, I will look at it only when I have to withdraw. And I think in most cases, in at least in our maths, in the majority of cases, you will be much happier that way than worrying about the day-to-day mark-to-market, which is in many ways, why should it impact you if you're not going to withdraw? It's not something that should get in your way.
Yeah. And there's a question by Mr. Iyer Ganpati that we should take. He's asking that there are many small finance companies which are coming to the market with good FD, with good return. Is it advisable to invest in these companies? I'll let you answer this first.
So unfortunately, I may not be qualified to answer this because I would not have studied how secure each of these companies are, how good their balance sheets are. But keep in mind, when you're lending money to a company, you are taking the underlying company's risk very directly. When you're giving money to a mutual fund, the mutual fund portfolio is comprised generally of securities, which are, you know exactly what you're getting. And like in our case, a lot of our portfolios are either AAA or GSEC or of that nature. So clearly of very high quality. So individually, one will have to look at what the sort of security risks are within that NBFC.
Yeah, Mr. Ganpati, we'll need more information to answer this question, but my basic answer is no. Point is, when you invest in an FD, please understand if that, one, you should not invest in direct FDs more than an X percentage of your capital, 10, 20 or 15 or whatever, 5. Because if that FD for any reason defaults, then your whole that percent corpus goes away. And I have seen people having their 100%, 50% of the corpus in one place. And even banks, like when that scare happened with the Yes Bank, or what happened with the PNC Bank in Bombay, don't have your 50, 70% corpus lying in one place. It's not right. You have to spread your corpus. And why would I invest in a small finance company FDs when I have a better alternative of if I have to do FDs, I'll do the best of the best companies, triple A rated, best of the best companies, because the 1 or 2% interest rate difference is not worth it. Second is that another the target maturity funds that we were talking about, which are pure gilt or government securities based, they are a great option. Today they are giving you 7.5% return in 4 to 5 years. They are much more tax effective. So also please look at pre-tax and post-tax return. Today you have insurance companies giving you 6.5% guaranteed returns for 5, 10, 15, 20, and these are tax free. So they are very good. They are secure. They have a double level of guarantee. First guarantee is through the products. Then these products are guaranteed by the shareholders. So in case there is a default, then the shareholders have to make good the default, which is not happening in any other case. So I think today there are many better options available. I won't personally take the risk. So I don't know why. Why would I? Please don't take this risk. Let me just. Uh, say it in that manner. And uh, and Vishal, you're very popular. A lot of people are really enjoying the talk and your views, so thank you for that. And there's somebody who's mentioned DHFL. Yes, it was a very sad case. It was a company with a triple A rating which went down. So these things can happen. So please learn. I think mutual funds are the right options, because they're what is the minimum number of what is the maximum amount of risk that can be taken in a debt fund. Vishal, what percentage of corpus can be in one security?
No, so one is of course the normal diversification one gets, Sanjeev, which is typically you will have at least 10 securities, more than 10 securities automatically. That's one. But the other thing is now the regulations have made it even more transparent over the last couple of years, because, and this is a bit technical, but for those who are interested, for debt funds especially, each fund has to define what is the maximum amount of risk you're going to take, and this is something called the PRC, or the product risk matrix, that is now available, which defines how much credit risk and how much duration risk at a maximum will you take. So it gives you the best ability for you to know, you know the max, which is how much can a fund manager do, because beyond that it becomes a regulatory violation, so no fund will allow that. And therefore you are there, given a very, very transparent way of knowing that if you don't want to take a certain amount of risk, then just stay with funds which have a PRC or the matrix which is less than your risk tolerance. So there are very strong reasons, and a regulatory environment we have is absolutely brilliant in many ways, which allows you to have a security level which is just incomparable to what you find in other parts of the market. So I would say that unless there's a very compelling reason for you to choose something else, why not just stick with the liquidity as well as the security of a mutual fund? And keep in mind that if something, as they say, if something looks too good to be true, it probably isn't. So there's a reason why someone is raising money at a very high rate. Keep in mind, if it's an NBFC which is giving you, as an example, 10%, that NBFC now has to lend in turn at more than 14-15% for them to make money. And if you're going to lend at that level, you can imagine what sort of credit risk you'll have to take to find borrowers who are going to pay that level of interest rate. So keep that cycle in mind.
Yeah, Vishal, that's a very, very right point. And there's a gentleman called Mr. Arunachalam who said that small banks are offering 8% and there is no risk up to 5 lakhs. That's absolutely true. Deposits in banks are guaranteed up to 5 lakhs. But that's across your accounts. So please keep that in mind, because that's a debatable thing. But generally, what we have seen that these guarantees across accounts. So, but yeah, that's a good opportunity. But you have to look at that 8% means if you are in a 30% bracket, you have to look at the kind of tax impact that you'll have, which is 2.4%. So that means you're left with a 5.6%. And if you invest in a 7% target maturity fund, due to the tax advantage over 3 years and inflation, you will, net return should not be, you should not pay more than 10% tax. So you will end up making about a 6.4%. And there it is also equally secured. So you have to take a calculated call that what is best, and please look at the post-tax returns. A lot of people make this mistake of looking at pre-tax returns. So thank you for an amazing session, Vishal. Thank you for taking out time today. Some final words for our viewers today, and we have crossed 18,000 live viewers today. So which shows your popularity.
Thank you, Sanjay. Thanks for having me. If I can just conclude with some of my, basic thoughts and some of the questions that I keep getting asked very often. It's about volatility in the market. I think everyone just talks about the fact that, look, markets are so volatile, and I find it difficult whether to enter or exit, etc., etc. And while this is, again, I know, preaching to the converted, but I, like we did for mid cap, I think it's just important to keep our basics always refreshed. Uh, so I think a couple of thoughts that I just keep at the forefront when I invest. Firstly, volatility is inherent to a market. If you did not have volatility, you did not have a market, because the fact is you need a buyer and a seller. Otherwise, there will not be a market in the first place. And therefore, the moment you accept the fact that volatility is inherent, you can't control volatility, you then shift your focus to what you can control. Right? So you can't control volatility, you can't control direction. And that brings us to the two, three, in a sense, if I can call it the eternal truths, right? What is absolutely true, which cannot change? First is, my favorite, which Sanjeev mentioned earlier, compounding. Compounding is a mathematical reality. So you make sure that you use that in your favor. And compounding simply means that, look, keep as much time in the market as possible, right? So make compounding work for you. That is an absolute reality. You cannot go wrong with that. Two is that, markets will have cycles. Cycles, business cycles is a reality, right? Now, two, you can get the cycle right, you can get the cycle wrong. The way out of it is diversification. So if you use these two realities as an anchor, saying that is always going to be true, then keeping money as long as possible, keeping saving and then making it work and keeping it as long as possible is one thing you can just tick off as a learning from the compounding formula. Diversifying to make sure that you're not out of step in any situation. You've got enough cash, you've got safety assets, and you've got enough growth assets is very important. And that will allow you to hopefully not take knee-jerk reactions. I know a lot of people actually missed out in the post-COVID sort of research, because everyone thought that, oh, end of the world, and this is now going to go down even further, and I'll get back at a certain level, I'll wait for a correction, and before knew it, this is almost a rally of a lifetime missed out for many people. So it's very important not to take these knee-jerk reactions and just respond to the immediate sort of urgency that any specific piece of news can create. Step back and look at, is that relevant for your goal or not? And if it is not, then why are you trying to do or take more action than necessary? So again, sorry, Sanjeev, for boring your viewers with a bit of unsolicited advice, but I just find it useful to anchor myself and my portfolio to some of these very simple principles.
No, no, I think they were amazing, and they added great value. And it's so good to see that we have Sandeep. Thank you for being an viewer from episode one and having watched every episode. And I love your comments and questions. And same is for a lot of others. My heartfelt thanks to all of you for taking out time, being with us, and the love and affection we have got. So thank you, Vishal, for taking out time. Thank you, viewers, for being here. And we hope that we were able to add a little bit value to your life.
Thank you, Sanjeev. Thank you all the viewers, and great opportunity for us. Really appreciate it.